What's up guys, and welcome back to the channel. If you're new here, my name is Nathan Scott and my goal here is to help you live life on your terms and not your boss's. Now in today's video, I'm going to be talking about a bear market that I see coming, what the Fed is, what they do, and how I'm personally going to weather this storm. And guys, do me a favor, hit that like button like it owes you money. So the Federal Reserve System, or also known as the Fed, was created on December 23rd of 1913 by Congress. Now they created the Fed, that way they had a way to manage money and credit and also promote growth throughout the economy. Now the Fed operates within a general structure of the government, however it is an independent banking system all of its own. And there's something the Fed can impose on its bank members that's called the reserve requirement. And what this is, it just refers to the percentage of each deposit that goes into a bank that must be set aside as a reserve. For example, if you go into a bank and you deposit $100 and let's say the reserve requirement is 5%, that bank has to hold 5% of that $100 or $5 and has to set it aside for the reserve. Now with the other $95, that bank is free to do whatever it wants. It can technically lend that money out through mortgages, auto loans, whatever it needs to, and that's how banks make their money. Now as of March of 2020, the Federal Reserve made the reserve requirement 0%. Now you're probably wondering,
Nathan, what does all this mean? Why are you telling me this?
I'm getting there, I promise. But first, I need you to understand that the Fed can increase or decrease the supply or circulation of money in the economy by requiring higher or lower reserve amounts for its banks. So when the reserve requirement is higher, the banks have less money to lend, therefore interest rates increase, borrowing and spending decrease, and vice versa. So if the reserve requirement is lower, then the bank has more money to spend and put out there with loans and everything. So interest rates may decrease, and when they do that, borrowing and spending increases. And they can't keep interest rates low forever because they're losing out on millions of dollars every year because interest rates are so low and reserve requirements are at 0%. And we've seen it time and time again when the Fed raises interest rates, we know what happens. Sometimes it's just a major stock market crash, other times it might be a recession, but what we don't ever know is when it's going to happen or when it's going to end. One of the Fed's members, Jim Bullard, just came out about a month ago and stated that he wouldn't be surprised if we saw the first interest rate hike in 2022. In addition to that, the actual Fed members just came out and announced at least 2 interest rate hikes that are going to hit us in 2023. Now, another way we can see the potential of a possible recession or stock market crash is something called the Shiller PE ratio. Now, the average Shiller PE ratio is 16.84%, and we are currently at 38.26. And I want you to look at this graph right here and look at where interest rates started to rise in the 2000s compared to where the S&P 500 was. You can see when the interest rates started going up, the S&P 500 had a steadily downhill turn, which was a bear market. Same thing happened again in 2006 to 2008. Interest rates started to rise, and you see there S&P 500 hit a peak and it also dropped again. Since then, we've kind of been on a steady bull market for about 11 years. Now this next graph I'm going to show you is just strictly the Shiller PE ratio. Now what I want you to focus on here is look at the PE ratio back on Black Tuesday in 1929. It was at 30. Like I said, the average was 16.84%. It peaked at 30 here and came crashing back down. The same thing happened right around the dot-com bubble where we were way up about 45 and we came back down to around as low as 15. We steadily started going back up and then coronavirus hit, and this one isn't updated for the coronavirus, but you get the picture here. You can see all these charts right here show you that when the Shiller PE ratio hit well above the average, everything sharply turned back down. Now after laying all this stuff out, I personally believe we will see a steep market correction somewhere between mid to late 2023 and early 2024. And personally guys, I love bear markets, and not because I'm losing money left and right. It's because I know that the companies I buy, I'm getting an amazing deal on. And if you somehow manage to time the market when COVID hit, from the very bottom to now, the stocks have rallied over 79%. So you ended up with a very impressive return on investment. And looking at our broader spectrum, all long-term investors have always made their money back. And one cool fun fact of the day here is that each and every official correction in the S&P 500 has eventually been erased by a bull run. All right guys, that is it for today's video. Thank you for watching. Be sure to like and subscribe down below. Leave a comment if you have any questions about today's video. And honestly, if you just have some stocks that you're interested in or something you maybe want me to make a video about, be sure to leave in the comments below. Also going to leave a link to Robinhood in the description below, so be sure to check it out. If you start investing today, we can both get a stock potentially valued up to $500. And that's all I got for you guys. Thank you, and I'll see you next time.